Barbara Doran of BD8 Capital Partners and Meghan Shue of Wilmington Trust. Good afternoon. Barb, we're above 5,300 on the S&P, but bumping around here, caught between excitement that inflation is cooling and fear that growth is cooling. Which matters more?
Well, I think we saw Tuesday and Wednesday the action was really worries about, well, maybe growth is cooling too much because you had the manufacturing was weaker than expected on Monday. You've had the ADP report today. You've had all sorts of indications that things are softening, which is what the Fed has wanted. But then you saw the action yesterday and Wednesday, I meant Tuesday on the other. And that was very positive. So I think that's really about the Fed will probably have to do 1 to 2 cuts. Some people had come down to no cuts, but you saw instantly the probabilities go up on the Fed funds futures. And so that's looking very positive here. So, and you've got earnings. You know, that's the question is, will this slowdown hurt earnings? But we just went through a great quarterly earnings reports with very optimistic forecasts from a whole range of companies. And I think that's what's going to continue to drive the market here. I think a normal pause here since earnings have finished will be expected, but as we've been talking about, the non-farm payrolls are tomorrow. That's going to tell us a lot. And then next week, we still have another round of CPI and PPI, not to mention the Fed meeting. So I think there's some important data coming up right now. So
we will get a lot of data, Meghan, on wages as well as employment overall. Is good news in this report? And perhaps that we're going to get tomorrow morning on labor. And perhaps more important is neutral news, like the expected. Is that going to be good or bad?
It's a good question. I do think we've had a little bit of a shifting back and forth between, do we want to see weakening data because that suggests inflation will not reaccelerate, or do we want to actually see good data because we've had really strong economic data. Ultimately, that has translated into really solid earnings from companies and ultimately higher stock prices. I still think at the end of the day, as much as we want Fed cuts, I would prefer to see better economic data that translates into stronger revenue and stronger earnings growth from companies. We are expecting and hoping for a bit of a moderation in the labor market and job growth that is going to settle around 150 to 200 net new jobs. Importantly, wage growth, which is pretty tightly correlated to things like the quits rate, we expect to continue to moderate. So that really means that you can get good job growth and not worry so much about higher wage growth pushing through into higher inflation.
Barbara, we've seen Treasury yields move meaningfully lower here in recent weeks. And I wonder how much that is signaling about this slowdown in growth, A, and B, the fact that we do see yields moving lower, how much that's also potentially pushing people off the sidelines out of things like money market funds and back into equities.
Well, I think it's all of the above. You know, I think that was why people were a little bit worried in the beginning of the week because yields were coming down, yet stocks weren't responding. So it's like, oh gosh, maybe it's there's more weakness than we realize. But I think as money market funds get less attractive, we've said over and over, there's $6 trillion in cash sitting there. There's been $40 trillion in wealth created since 2020, and the retail investor is starting to come in. So I think, and you've seen a record inflows into ETFs, equity ETFs in particular, and I think and you've seen all the publicity that Roaring Kitty is getting, turning a $53,000 stake 5 years ago into nearly $300 million, and with NVIDIA. You know, and the action there and this 10-for-1 split coming up, I think the retail investor has the cash to invest, and I think they're coming back in. I think that's being an important support. So,
yeah. Meghan, I do want to get your thoughts on some of these mega cap tech stocks like NVIDIA, for example, because they have been powering equities higher. And yes, it looks like we're finishing the day lower for the major averages, but not before kissing a new intraday record earlier in the session. Do you continue to stay invested in those names, or do you diversify and broaden out?
Yeah, I think the second half of 2024 and beginning of 2025 will really be a story where when you're thinking about building a portfolio, balancing exposures is what is going to work. And by that, I mean continue to hold on to and own that mega cap tech AI trade, but also look to broaden into other parts of the market that just haven't participated quite as much with performance and certainly as a share of the S&P 500's earnings. If you look out over the next year, we expect that to be more balanced. I think you're going to continue to see AI play an important role. It's just going to be maybe less about hardware and more moving into some of the other areas, software, cloud, which have lagged a bit, and then even some of the sort of second order effects of AI, whether it's power generation that we've been seeing moving utilities, or some of the smaller companies that might be the biggest beneficiaries of the productivity boost. So I think it's important to be really balanced as you're thinking about managing risk in what is probably going to be a really challenging environment, a good environment from an economic perspective in terms of continuing this cycle and getting that soft landing, but a much more differentiated stock market where active management should do well, and it's going to be really important to find companies that are executing.